Well, Transaction Capital has improved its financial position. In the half-year period, the SA taxi owner narrowed its total loss per share to just over 172 cents from a loss of 222 cents. This comes after it spun off WeBuyCars and separately listed it on the JSE. This move saw it return 5.2 billion rand to shareholders and raise 1 billion rand, which allowed the group to pay down its debt and move into a net cash position. And joining me now as we take a closer look at how the company plans to strengthen its balance sheet is CEO Jonathan Jawno. Thank you so much for your time, Jonathan. I know that the results commentary said that these results should be looked at from the point of view of the progress that you have made in moving towards your strategic goals, but I mean, we still do need to look at the fact that Transaction Capital is still in a loss-making position. Of course, we'll go into the pockets of those strategic goals a little bit later. But just looking at that loss, although it has narrowed, of course, it points to the pain that SA Taxi is still inflicting. How much or what level is that on at this point?
Well, when you say what level, I think that the entire losses that the group is reflecting relate to SA Taxi, you know, and it's not like that. It's not that we are trying to deflect from that. When we say to shareholders, one has to look at everything that has gone on in the year, because in the 6 months, because a lot has happened, and it's all relevant. But at the end of the day, one can't shy away from the fact that SA Taxi is still a business in distress. It is a business that has made remarkable recovery, and we have worked extremely hard to reposition it and make sure that it does have long-term relevance in the taxi industry. One has to appreciate that this is a business that has been around for 20 years, and it has funded tens and tens of thousands of clients. All clients that would not have been funded through the traditional banking sector. So it plays a pivotal role within the taxi industry. Yeah. And it has come through a very difficult period, the kind of COVID and the period beyond COVID. And it just would be a tragedy that kind of one hiccup, if I can call it that, not to play down the size of the loss, because billions of rands have been lost. But still, it's in a context that really underpins the whole transport sector of South Africa. And it would be a tragedy if one period, call it 3 or 4 years of a bad trading period, would result in the company not surviving and the country to lose that player in the position where it is, you know. The difficulty, of course, is that if SA Taxi were to sit in a bank, then the losses would be absorbed and would be reflected across a broader asset base. So it's not to say that this is the first company that in the history of the country that has absorbed losses off a consumer book. But it's because it's a single business in a relatively small company, being Transaction Capital, that the losses are highlighted. But that aside, we have to deal with them, and we have to restructure the business so that it is relevant for funders to want to fund us, because at the end of the day, that is what is crucial.
Well, what does that actually entail, that restructuring?
Right. So effectively, there's two sides to the restructuring. First of all, there's been a significant operational restructure. I think people would not recognize the business. There's not been one stone that is left unturned from the management that have been replaced or recalibrated, repositioned, all the way through to the most small process within the business. Secondly, strategically, the company has stepped out of the financing of the new taxis and gone into a purely second-hand player. And I think that we're the only ones in South Africa that are doing that. And I think that is highly relevant going into the future, because it's the cost of the taxi that has actually put massive pressure on the taxi industry. And that cost has just gone up and up with inflation, interest rates. Then you add to it fuel prices, but the core cost is the actual cost of the taxi. And the only way, well, the way that we're responding to it is to produce a quality second-hand taxi, which reduces the cost dramatically and gives the operator a better chance to be profitable. And then ultimately, the restructuring of the banks really, not only the banks, but the broad funder base, really requires them to stay with the company longer, instead of letting the debt run down as it would in the ordinary course, to reinvest those proceeds and allow those proceeds to be reinvested to new operators. That, of course, has a multiple knock-on effect, because it will reduce the ultimate losses within the portfolio. It will also breathe life into all the subsidiary and other ancillary businesses that sit in Mobilize, and that in turn creates equity value. So it's quite binary. In other words, you either have a decent outcome or terrible outcome. Yeah. But I think we're getting to that point where we have hopefully moved into the decent outcome. The proposal that we have made to funders, by and large, in principle, the philosophy and the principles of it have by and large been accepted. But still, there's a way to go from accepting a proposal in principle to actually get money to change hands. That's the process that we're in now.
And if it doesn't happen, because obviously as a business you have to think of the different scenarios, considering how critical it is to the success of Mobilize.
Absolutely. So there really are only two scenarios the way we see it. Either the business winds down over time, which is, call it the disaster scenario, or we move forward with our proposal in one form or another. It's not an absolute thing. It can be tweaked, it can be changed, but the philosophies and the principles, I think the words we used, that this will form the basis of the restructure, and that's what we believe. And we are engaging with all the funders, and we hope that the terms under which that they will support this restructure will be good for everybody, and that is the movie that we're in right now.
All right. Well, moving into your other division, which is Newton.
Yes.
I do understand that revenue there did see some pressure, and I think from what I understood, it was due to some pressures in your CE business, where obviously you buy non-performing loan portfolios, and it seems that there was a difference in expectation of pricing between yourselves, the buyers, and the sellers. What actually is behind that?
What does that mean in simple terms? It really means that the way we see it, we've been in this business for 25 years. We started this industry in South Africa. We're the biggest player in this industry in South Africa. By that I mean the buying of NPLs. Now, what has happened over the last year or two, the position of the consumer has come under massive pressure across every sector. I mean, taxis one, they're not a consumer, it's an operator, but this is now a regular consumer. And we have seen a decline in the credit, in the ability to recover and collect from these consumers. And for us, that reflects in the price that we are prepared to pay for those books, because we buy those books for cash and we collect on them, sometimes over periods of 5, 8, 10 years. And we have, our models predict what the collections will be, what the costs will be, and that is how we derive at the price that we prepare to pay. Simply put, where we are at the moment, and we have been here before, so this is nothing new, because of the rapid decline in the consumer environment, we are finding that there is a gap between what we are prepared to pay for these books and what the sellers are prepared to accept for these books. Simply put, it means we have a different view to them on the collectability of those books and the recoverability of those books going into the future. But we have to be very rigid and conservative, and if we find ourselves in a position where the books are priced at levels beyond which our risk tolerances will accept, then we have to step back and not buy, like we did in this period where we spent literally 100 million. I don't think we've spent that little in 10 years. But that is important to understand in the business of Newton, why we have the services business or the BPO business sitting within Newton, because that is driven off completely different fundamentals, and that allows us ultimately to grow the overall business even in a period when the capital-enabled businesses, as we call it, is under pressure. And by under pressure, I mean under pressure to grow. Obviously, the existing portfolio performs decently.
Well, still in Newton, the CX services business as well, talking about mismatches. There was a mismatch there between the cost that you put in there and the income you got, that there seemed to be a delay in the demand that you expected. What was behind that? Okay,
so that I think is something that is just a temporary nature. It's not a structural or strategic thing. That is simply a management misjudgment on the timing of onboarding business, in other words, to preparing, and that shouldn't happen. It did happen. I think we attribute it to a business that's in flux, because there's so much going on. We have sold one subsidiary, we're in the process of selling another subsidiary, we have split the businesses into two, we have lots of major management changes. So all things that we are doing there that we think are right for the business, I would say this is maybe just a cost of being in such a period of flux, but nothing that doesn't in any way impact the vision for the business, the rationale for the business, and why we continue to invest heavily in that business.
All right. Well, let's talk about that balance sheet. I did mention in the intro that you are now at a net cash positive position. How is that looking like, but also relative to debt?
Yes. So I think, first of all, we're very happy with the progress that we've made on restructuring the balance sheet. What we have to understand is that within a core principle of transaction capital has always been that there has never been one balance sheet. We have always run each business on a completely standalone balance sheet, and that has cost us a lot over the 20 years that the business has been around, because each business has been judged and the cost of the credit has been priced based on a standalone business and not a holistic business. So what has happened now is that the taxi business has been going through this pain and their losses have been incurred, and that has damaged the balance sheet but the other businesses remain very healthy. So We Buy Cars was able to be unbundled with a very healthy balance sheet. Newton has a very solid balance sheet, and through the restructuring, through the sale of Australia, through the sale of our payments business, all of stuff that the one is done, the other is almost done, further bolster that balance sheet to support the growth of that business. And then the transaction capital balance sheet was, of course, had leverage. The leverage came about, ironically, out of the transaction capital investing or supporting SA Taxi to the tune of 2.2 billion rand, and actually incurred leverage to give that shareholder support. But now, through the unbundling of We Buy Cars, we've managed to settle that. So we now sit in a much cleaner situation where We Buy Cars is unbundled, that it's got its own balance sheet, which the market sees independently. The transaction capital balance sheet now is completely debt-free. The Newton balance sheet is very much strengthened. Not that it was a weak balance sheet, but it's a much enhanced balance sheet. And the taxi balance sheet is the subject matter of restructure. So 3 separate pockets. We manage them all differently. We look at them all differently, but that's how we see it.
All right. Well, let's wrap up the conversation, and of course, now talking to your investors, because a lot of them are wondering when transaction capital will actually get to a solid point of profitability, as you're obviously undergoing this restructuring. Is this a multi-year turnaround effort?
Right. So I think taxi is a multi-year turnaround effort. There's nothing to discuss. Taxi doesn't turn around in 6 or 12 months. I think Newton is profitable, and its profitability will continue to grow. Transaction capital is just a sum of putting the two together because we consolidate them. So even though there might well be losses in taxi, those losses are ring-fenced to taxi. So when you report consolidated losses, that's an accounting concept. But in actual fact, shareholders benefit from the Newton gains directly. And Newton is profitable and has been for many, many years, and is on a growth trajectory. And of course, We Buy Cars is listed on its own. So I think we are already there. I think Newton has got a very strong growth story, and taxi will take several years. There's no quick fix. This has got to be fixed carefully and slowly and conservatively.
All right. And is there any way now, are you at that point where your taxi doesn't necessarily filter through, or the nervousness of SA Taxi doesn't necessarily filter through to Newton? Because I do understand also Newton is also capital enabled.
Yes. Well, I think Newton is capital enabled in the book buying business.
Yes.
The BPO business is not, but still Newton as a business does need the support of funders.
Yeah.
And that is something that we deal with every day. So in other words, there are many funders that see Newton and fund Newton on its own balance sheet and are more comfortable. There are other funders that are reticent because of the losses in taxi to support Newton, and that is something that we just have to win them over time. But clearly they are separate balance sheets, they always have been, and we'll continue to run them that way.
All right. Well, thank you so much for your time and detailing those numbers for us, and obviously the prospects for transaction capital going forward. That was the Transaction Capital CEO, Jonathan Jawno.